A moving average is a lagging indicator that displays the average price of a security, such as a stock, currency pair, or cryptocurrency, over a specific period of time. It helps smooth out price fluctuations and noise in charts, making it easier to identify trends and potential areas of support and resistance. Moving averages are not predictive but rather interpretive, confirming trends that have already occurred. Moving averages come in various lengths, and traders choose them based on their specific goals and time frames. Long-term moving averages can be 200-day, 100-day, and 50-day. A 200-day moving average is a significant indicator in trading. As long as the 50-day moving average remains above the 200-day moving average, it's generally considered to be in a bullish trend. A crossover to the downside of the 200-day moving average is interpreted as bearish. A 100-day moving average is another long-term moving average that helps identify overall trends and support resistance levels. A 50-day moving average is often used for identifying significant support and resistance levels. It's considered a reliable trend indicator. Near-term moving averages can be 20-day, 10-day, and 5-day. A 20-day moving average is useful for spotting near-term trend changes. Changes in direction by this shorter-term moving average can provide early clues to longer-term trend shifts. A 10-day moving average is frequently plotted on hourly charts for intraday trading guidance. A 5-day moving average is even shorter-term, useful for identifying very recent trends. Traders can apply these moving average lengths to any chart time frame, whether it's 1 minute, daily, weekly, or any other interval. Remember that moving averages are just one tool among many, and combining them with other technical indicators can enhance your trading strategies.